It's been a pleasure to be invited back by the folks at Fidelity Bank to spend a little bit of time with you this evening, help you understand what the Social Security program is, recognize what it isn't, want to dispel some of those myths and misunderstandings that are out there so prevalently, and set you down the road to the comfortable retirement we all hope to enjoy. Next slide, please. Key message for me tonight, you'll hear me reference it over and over again. People need to understand that when Social Security was created over 86 years ago, the program was put in place simply to provide you with a base or foundation of income protection that you could definitely count on being there for you. But it's a base of income protection that people must take steps to supplement, because Social Security was never intended to be anyone's sole source of income in retirement. But unfortunately, these days, about 21% of retiree couple households, the Social Security money that comes into them is virtually the only income they have. A terrible situation. So how do you avoid that happening to you? Well, simple. By planning for retirement. And you'd be commended taking time out of your busy schedule, spending a little time with us this evening, planning for your retirement. Now, for the longest time, Social Security did try and help people plan for retirement, because you may or may not recall, back in the day, they used to mail you on an annual basis a paper document, a Social Security statement. Statements started going out back in 1999. The original distribution plans had that statement going out, showing up in somebody's mailbox. Next slide, please, Brad. Showing up in somebody's mailbox about 3 months before his or her birthday on an annual basis. That statement designed to provide people with retirement planning information, benefit estimates at 3 different ages. And the other thing the statement did that was so important, it provided you with a year-by-year breakout of what the Social Security Administration had recorded as your work and earnings under the program. And we'll talk in a second how that benefit gets calculated, and you'll see it's important to keep track of what your earnings have been, because if you don't, it will have a direct impact what you eventually collect each month from Social Security. But just a reminder, Social Security no longer mails paper documents to everyone on an annual basis. Instead, what they've done first and foremost is put in place a system whereby if you go to www.socialsecurity.gov/myaccount, take about 10 or 15 minutes or so to set up an individual Social Security account for yourself. An important byproduct of having that account in place is you'll be able to download through a secure website a Social Security statement for yourself whenever you need one or want one. So a homework assignment for me tonight, if you've not yet set up your individual My Social Security account, I encourage you to do so. Down the road, once you start to collect, a lot of advantages from having that account in place, but prior to retirement, being able to download and have a current Social Security statement is going to be a hugely important tool. You're going to meet with Eric, do some retirement planning. Being able to bring a current Social Security statement to that meeting is going to make it far more worthwhile exercise. So I encourage you to do that. Take advantage of that planning tool, plan for retirement. Recognize that the Social Security program designed to provide you that base, that foundation of income, but it's a base of income you must take steps to supplement, because it was never intended to be your only source of income in retirement. So next slide, please. We'll talk about retirement in general, and I'll turn it back to Eric with a polling question.
Eric, you're mute.
I was trying to stay on mute on purpose. We had a poll put up on the right. Hopefully you saw it. What is the most popular age at which people start collecting Social Security benefits? Brad, do you have the poll results?
Yeah. So there's 62 people that are able to vote. Of those, 6 said 62 years old, 10 said 65, 9 said 67, and 1 said 68 and a half. So the most popular answer was 65 years old.
Great. Good to get those results, and that's wrong. The most popular age at which people start to collect Social Security benefits these days is age 62. So let's talk about retirement benefits and when you can start to collect. Now, understand this, under the rules of the program, you've got a lot of choices, you've got a lot of options. What I'm trying to do this evening is make sure that you fully understand those choices and options. In other words, that you fully understand what you can do under the program. But I'm never going to sit here and tell you what you should do, because I believe that's firmly your choice, your decision. After all, you're the ones who've worked and paid into the program. But I also firmly believe that if you don't fully understand what you can do, you're in no position to decide what you should do. So let's make sure you understand the choices and options that are available to you. And the place to start is by making sure you know what Social Security calls your full retirement age. Key concept under the program. When Social Security started back in 1935, Congress set full retirement age as the month someone hit age 65. It was age 65 for everyone without exception. In fact, continued that way till 1983, when Congress changed the law and increased Social Security full retirement age for anyone who was born 1938 or later. Now, this increase gradually been phased in over time. Now, for a big chunk of the baby boomers, any of us who were born between 1943 and 1954, our Social Security full retirement age, for example, was the month we turned age 66. But it's important to note, it continues to increase beyond that. And under current law, tops out anyone born 1960 or later has a Social Security full retirement age as the month you turn age 67. Now understand this, collecting at your full retirement age month, it isn't your only choice. Excuse me, it isn't your only option. But in planning for retirement, make sure you know what your full retirement age month is based on your year of birth, because you'll see as we go through the discussion this evening, a lot of features of the program do flow from at least having reached your Social Security full retirement age. Next slide, please, Brad. But in terms of collecting benefits, you have to start the month you reach your full retirement age. That means one thing and one thing only. It means you'll receive 100% of the amount your work and earnings have entitled you to collect. And we'll talk in a second how that all gets calculated. But starting at your full retirement age month, whatever it is, you get 100% of your benefit. But you've got other options besides starting at full retirement age. And under the rules today, you can start to collect your retirement benefit as early as the month you turn age 62, or at any point in between, by the way. But here's the thing, Social Security, as the name implies, is a social insurance program. And Congress has built certain social goals into it. And one is a hope that at the end of the day, based on average life expectancy, you'll end up with roughly the same amount of total lifetime benefit payments, regardless of when you start to collect. And so you have to start collecting payments prior to reaching your full retirement age. Well, then by starting sooner, in theory anyway, you'll be collecting for a longer period of time. Well, you'll find that your monthly payment amount has been reduced. How much a reduction? Well, it's roughly 0.5% per month reduction for each month prior to your full retirement age that you opt to start collecting benefits. 0.5% per month translates into a roughly 6% per year reduction by starting early. But it's important to note you don't have to start first of the calendar year. You don't have to start on your birthday. But if you opt to start collecting prior to hitting your full retirement age month, you'll find that full retirement age benefit amount has been reduced by roughly 0.5% for each month you're going to collect. And oh yeah, it's a permanent reduction. Another one of those myths are out there. Too many people mistakenly think, yeah, I know, I'll start early and I'll get less, but as soon as I hit my full retirement age, my payment will zoom back up again. A permanent reduction. Again, the idea being you're starting sooner, In theory, then, based on average life expectancy, you'll be collecting for a longer period of time, so you're given less on an individual monthly basis. As I mentioned, you start right at your full retirement age, you get 100% of your payment. But among the options you have are to wait past your full retirement age before starting to collect, if that makes sense for you. And with that social insurance idea in place, then, if you opt to defer for a little bit, well, then by starting later, in theory anyway, you'll be collecting for a shorter period of time based on average life expectancy. So by all rights, your payment amount ought to be increased if you wait. And it is. These are referred to as delayed retirement credits. And for each month past your full retirement age, you opt not to collect. You'll now see your benefit permanently increase by 2/3 of a percent. 2/3 percent per month, that translates into an 8% per year increase by waiting to start. But again, you don't have to not collect for a full year. For each month past your full retirement age that you opt not to collect, you'll see your benefit permanently increase by that 2/3 percent per month. But here's the key thing. These delayed retirement credits only accrue from your full retirement age month until the month you turn age 70. You understand this, under the rules of the program, you never have to take your Social Security benefit payments. It's not like there's a required minimum distribution or anything like that. But you opt to defer from your full retirement age until age 70, you'll see your benefit increase by 2/3 of a percent for each month you haven't collected. You opt to wait past that point, it's your right to do so, but there'll be no additional increase in your payment if you've opted to wait. So let me give you an example to illustrate what I'm talking about. Next slide, please. Here in our example, we've got somebody with a full retirement age of 67. And let's say at her full retirement age of 67, she'd receive $1,000 per month. What are the options that are available to her? Well, she wants to start collecting right at that earliest point, right at age 62. The way the reduction factor works out, she'd receive 70% of the amount she'd receive at her full retirement age of 67. In other words, she won't get $1,000 a month. No, she'll get $700 per month and continuing. Well, yeah, she's getting $300 less each month than she'd receive if she waited, but the trade-off, obviously, she receives that lower amount sooner, and in theory then collects it for a longer period of time. We'll say she wants to wait a couple of years, start at age 64. Well, payment will be higher. At that point, she'd get $800 per month and continuing. She waits all the way till her full retirement age of 67. That's when she'd get the full $1,000 that her work and earnings entitle her to collect. But say she wants to wait all the way until age 70. Well, by waiting that 3 years, she'll see her payment increase by 8% for each one of the 3 years she's waited. And it's simple interest, not compounded. But it means starting at age 70, she won't get $1,000 a month. No, she'll get $1,240 per month and continuing. Bottom line in all of this, as I say, it's your choice, your decision. You're the ones, after all, who've worked and paid into the program. But what are the things you ought to be thinking about? You know, as well as I do. Your health, for one, right? Longevity, for a second factor. As I always ask, do you come from a family of long livers? Or do you come from a family of short pancreases? Bum. It's a line out of the movie Goodbye Columbus from 50-something years ago. I can't take credit for it. But the whole idea behind it always used to be that based on average life expectancy, it really wasn't supposed to matter. You'd end up with roughly the same amount of total lifetime benefits, regardless of when you started to collect. But you know what, folks? Life expectancy is increasing. Social Security numbers say today's 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 age 95. We boomers and those who come beyond us need to recognize that for us, retirement could be a period of 20, 25, or maybe even 30 or more years in length. And my personal view tends to be that for most of us heading into retirement these days, we boomers, if we have any type of pension at all, far more likely to be the defined contribution type, right? 401k, 403b, 457. Where we're walking out the door at retirement, not with that guaranteed stream of lifetime income like you used to get with your defined benefit pension. No, you're walking out the door instead with a pile of money. And seems to me that later in retirement, that pile of money will have diminished somewhat. Later in retirement, healthcare costs may be higher. So you may have a greater need for a higher monthly income later in retirement than when you make that initial transition. But again, it's not for me to say, it's your choice, your decision. I want you to understand the fundamental concept, which is you start sooner, you get a lower amount for the rest of your life. You wait longer before you start, you get a higher payment amount for the rest of your life. But again, the key thing, when Congress set the reduction rate, increase rates so many years ago, based on average life expectancy at the time, excuse me, it was all supposed to come out about even. But these days, because life expectancy is increasing, I tend to think that good things come to those who wait. But let's do our next polling question and see how many people tend to wait until age 70 before starting to collect.
So the results came in from the poll that 15 out of 65, so the preponderance, more people thought only 4%. And then the rest thought it was either 10 or 22. So most people thought that it was the very small percent of people that actually
And the correct
wait till
answer,
they're
the
70.
correct answer is about 10% of Social Security beneficiaries these days do wait all the way until age 70 before starting to collect. But I think the number is increasing as, again, more people are educated about the way the program operates, understanding that with life expectancy increasing, it may make sense for someone to wait before starting to collect. But it's going to continue to be a long uphill struggle. As we saw in our prior question, the most frequently selected age is right at age 62. And we'll see as time goes on how those numbers shake out. But right now, it's about 10% of folks who do wait all the way until age 70 before starting, although that number is increasing a little bit. Next slide, please, Brad. So I always like to remind folks the decision to start collecting retirement benefits doesn't have to be an irrevocable one. So I always like to remind folks, if you change your mind about starting to collect, you've got a couple of different options that you can pursue. I want to make sure you fully understand those. The single biggest option that's available to you is if you completely change your mind about starting to collect. Start to collect, say at age 64, you've retired and you realize, retirement isn't for me. Maybe I've made a mistake. Well, under the rules of the program, as long as you have been collecting for fewer than 12 months, you retain the right to what is called withdraw your application for benefits. By doing so, you basically tell Social Security, I've changed my mind, and you want a do-over. And to have Social Security grant that request, you simply need to do one thing and one thing only. You have to repay all of the benefits that you had collected. But the key thing is no interest is charged. You simply repay the principal. And once that check clears, it's as if that earlier application had never occurred, and you're free to reapply at a later date at whatever point makes the most sense for you. But the key thing is this ability to completely withdraw your application, repay, and reapply at a later date. You can do that once in a lifetime, and only if you have been collecting for fewer than 12 months. But there's another option that's out there you need to be aware of. Another area where it's important to know what your Social Security full retirement age month is. Because under the rules of the program, if you have reached your Social Security full retirement age, whatever it is based on your year of birth, one of the options that you have these days, excuse me, is to request what is called voluntary payment suspension. To do that, you simply call up Social Security and say, in essence, I'd like a timeout. I'd like to not collect my payments for a few months. By doing so, you won't collect anything, but you're now, because you're over your full retirement age, you're back in the business of accruing those delayed retirement credits, and you're growing your benefit payment by 2/3% per month, 8% per year, for as long as you opt not to collect them, right up until age 70. Again, this ability to request voluntary payment suspension only kicks in at or after your full retirement age month. But it's also important to note, yeah, for voluntary payment suspension, excuse me, it's not like you're locked out for till age 70. No, you can stop and start as many times as you'd like. And this ability to request voluntary payment, excuse me, suspension applies no matter what age you had started to collect and no matter how many months you had been collecting. But you do have to be over your full retirement age. But it's a way that you can perhaps make back some of that initial reduction in your payment that you had incurred by starting at an earlier date. So again, two options. This decision to collect doesn't have to be an irrevocable one within a year. You can withdraw, repay, and reapply. And after full retirement age, you have this ability to request voluntary payment suspension. All right, let's segue into a discussion of how benefits are calculated. Before we get there, though, let's do another polling question. Eric?
So the question is, the amount of someone's Social Security retirement benefit is based on what number of years of earnings? And the polling results are not coming up. We have the polling results, Brad?
Yes. Out of the responses, 10 people responded with 35 years of earnings. So number 3.
All right, next slide, please, Brad, then. So let's talk about how Social Security retirement benefits are calculated. Another area where there's lots of myths and lots of misunderstandings. As I mentioned before, there is a relationship between your work and your earnings and what you eventually collect, but we'll see it's not a perfect correlation. But in calculating benefit payments, Social Security simply uses a formula that Congress has written right into the law. Formula has a number of different steps. First step is that Social Security will go back and adjust your prior year earnings for inflation, bring them up to what they are in today's dollars. But then they calculate your benefit by averaging, as you can see on the slide, and as the polling question revealed, your highest 35 years of work under the system. I don't know how many folks I've talked to over the years who mistakenly think it's my high 3 or my last 5, like some other pension systems that are out there. Social Security benefits are based on an average of a lifetime of earnings, which these days defined as your highest 35 years of work under the system. So what happens if you don't happen to have 35 years of work under the system? You've taken time out of the workforce to raise kids, care for aging parents, perhaps work for a while in a job where you haven't been paying into the Social Security program. Unfortunately, no provision for that. It's still going to be an average of your 35 highest years of work under the system. And if you don't happen to have 35 years where you've actually contributed to Social Security, zeros get added in for those additional years. It lowers your average monthly wage, and it lowers the benefit that you collect. Next slide, please, Brad. Here's another reminder about Social Security being that social insurance program that I referenced. And in putting that formula in place, Congress has recognized that people in lower paying jobs are less likely to have a pension, less likely to be able to save for retirement during their working years. So the formula tries to help people in lower paying jobs by providing a benefit which is intended to replace a higher percentage of the person's pre-retirement income, somewhere in the neighborhood of 55%. Now, for a higher earner, by all means, he or she receives more each month in absolute terms than the low earner does. But if you look what that payment represents, it's actually designed to replace a smaller percentage of the person's pre-retirement income, somewhere in the neighborhood of 34%. And for the average worker these days, a Social Security benefit only intended to replace around 41% of what someone's making at retirement. Which leads us back to that first slide I showed you. In no case, low earner, high earner, or average earner is a program intended to replace 100% of what someone's making at retirement. You need to recognize it's intended to provide that base, that foundation that you can definitely count on being there, but it's a base or foundation you must take steps to supplement. And the sooner you recognize that, work with Eric to find ways you can move from what Social Security provides to where you need and want to be for that comfortable retirement, the more likely you are to achieve that. So I'm going to give you a couple of numbers to think about, but let's start with another polling question about average Social Security retirement benefits in 2022.
So Kurt, what exactly would that number be?
Well, ladies and gentlemen, this is like, if you remember the Jerry Lewis telethon where he'd always have Ed McMahon, he'd go, roll the big board, please, and they'd reveal the number of people who had contributed to the muscular dystrophy telethon. Well, in 2022, the average Social Security retirement benefit being paid is option C there. It's $1,657 per month, the average retirement benefit, $1,657. Now you multiply that out over a course of a year, comes out to $19,884 over the course of the year, a little under $20,000. Nothing to sneeze at, but again, designed to provide a base or a foundation that you can count on, but you need to find ways to supplement it. So then in a related issue, often get asked the question, excuse me, is there a maximum payment that Social Security makes? Well, qualify it in the year 2022 for someone who this year is at his or her full retirement age, which is 66 years and 4 months, and who for each of the past 35 years has had earnings at or above whatever the taxable maximum level of earnings has been for each one of those 35 years. That's an important point. Each year there's a maximum level of earnings upon which you pay Social Security tax. In the year 2022, for example, you can make $500,000. You only pay Social Security tax on the first $147,000 that you make this year. So when it comes time to average your earnings to calculate your benefit, Social Security won't average in that total $500,000. No, they'll only average in earnings that had been subject to Social Security tax. So to recap, in the year 2022, someone at his or her full retirement age of 66 years and 4 months this year, and who for each of the past 35 years has had earnings at or above the taxable maximum level for each one of those years, this year he or she receives $3,345 per month, $3,345 at full retirement age, which translates into an annual total of $40,140. Again, $1,657 average Social Security retirement benefit, $3,345 maximum payment for somebody this year at Social Security full retirement age. Hugely important program. You can count on it being there. But again, you need to find ways to supplement it because it was never intended to be your only source of income in retirement. Oh, by the way, if I'd been given the full 8 hours that originally had been promised me by Eric, we'd be going through this in excruciatingly painful detail. So I want to remind you that if you're looking for more information about how benefits are calculated, Social Security's website has a great deal of information at www.socialsecurity.gov/ and then in all capital letters OACT, which is an abbreviation for the Social Security Administration's Office of the Actuary. Y'all know what an actuary is, right? An actuary is somebody who doesn't have enough personality to be an accountant. Ba-dum-bum. All right. I can tell that joke because Social Security's chief actuary, Steve Goss, told it to me. All right, next slide, please. So we've talked about the when you can collect. We talked about how benefits are figured. I want to spend a little bit of time talking about working in retirement because this is another area people have a lot of interest in. And this is yet another area where it's really important to know what your Social Security full retirement age month is. Because under the rules of the program, if you're looking to collect benefits prior to hitting your full retirement age month, but intending to work at the same time, you need to understand that you're limited and how much you can earn before it impacts your ability to collect. This year, 2022, for example, you're allowed to make up to $19,560 without any loss in benefits while you're under your full retirement age. You make $19,560 or less, yeah, you'll collect full payments all 12 months of the year. Now, you make above that doesn't mean you can't necessarily collect, but Social Security is then required to start holding back $1 in benefits for every $2 that you're over the threshold. So depending on how much you're making while you're under your full retirement age and working, you may not be able to collect even if you choose to. So what counts towards that $19,560? Two things only: wages and or net income from self-employment. In other words, earned income only. Any unearned income you might be receiving, like a VA benefit, General Motors pension, bank interest, dividends, 401k distributions, none of that counts towards that threshold. Earned income only. But the great news is, from the month you reach your full retirement age on, there's no longer any earnings limitation imposed on you whatsoever. From your full retirement age on, you can work and earn as much as you'd like and collect full Social Security benefits at the same time. I don't know how many times I've been asked the question, hey, I'm retired. I'm thinking about going back to work, but I'm not going to have to pay Social Security tax on my earnings, am I? You're in a job covered under the Social Security program. Even if you're retired, you're going to pay Social Security tax on those earnings, which is good news for the good folks at Social Security because they can certainly use the money these days. But there's potentially good news for you. As I mentioned, benefits always calculated by averaging your highest 35 years of work under the system. The key thing is it's not necessarily your first 35, not necessarily your last 35. It isn't even necessarily 35 consecutive years. So even if you're retired collecting benefits, if you return to work, well, at the end of the year, you'll file your tax return. Social Security will automatically do a match. They'll compare that new year of earnings with the lowest of the 35 years they've been using up until that point to calculate your benefit. And if that new year of earnings is higher, they're going to drop out the low year, plug in the new year. It will result in a benefit increase for you going forward. And this ability to increase your payment through additional work and earnings, it continues forever. Delayed retirement credits, that bump because you haven't collected, yeah, those stop when you reach age 70. But no matter how old you are, if you're working and paying into the system and your earnings are higher than the lowest of the 35 years that Social Security had been using up until that point, well, the great news is you're going to see a benefit increase as a result of those additional earnings. And frankly, the other bit of good news is after full retirement age, work never really hurts. You've been a high-priced executive, but in retirement, take a part-time job at the Stowe Acres Country Club, driving the beer cart around. And at the end of the year, make a couple $1,000. Well, that couple $1,000 probably going to be lower than the lowest of the 35 years that Social Security had been using to calculate your benefit. So what happens to your payment amount going forward? Nothing. Stays the same because it's always based on an average of your 35 highest years of inflation-adjusted work, regardless of when they occur. So I think good things can come to those who work. As long as you're working and paying into the system, there's always the possibility that those additional earnings are going to increase your benefit, but they're never going to reduce it. All right, next slide, please, Brad. So let's talk about spousal benefits, divorce spousal benefits, and survivor benefits under the program. A lot of interest in these topics as well. Social Security spousal benefits, divorce spousal benefits. For the longest time, there were a number of Social Security claiming strategies that were all the rage, ways that people could optimize or maximize their lifetime Social Security benefits for couples. Well, these strategies were so good that Congress eliminated them with passage of something called the Bipartisan Budget Bill of 2015. And so these days, in terms of spousal and divorce spousal benefits, we're back to the basics, blocking and tackling, if you will. So let's help you understand how spousal benefits work. And when I illustrate spousal benefits, I always say the program designed to reflect the American family model of the 1950s and the 1960s, which is when you had Ward Cleaver and June Cleaver. Ward was the breadwinner. June Cleaver was a stay-at-home mom. And what the law says is Ward Cleaver, he'll get a benefit based on whatever his work was. June Cleaver, as Ward's spouse, is going to be eligible to receive a payment equal to 50% of Ward's full retirement age amount that's paid to her in addition to the money that's paid to Ward, even though she may not have worked a day outside the home in her life. Now, for June to collect, few conditions have to be met. Ward has to be collecting. All right, June can't receive a spousal benefit unless and until he's actually collecting. Second, June has to be at least age 62, earliest age a spouse can collect, no different than under the regular retirement program. And the third thing to remember is a spousal benefit is based on 50% of the worker's full retirement age amount, not necessarily 50% what he or she might be collecting. But that's the 50s and 60s, right? When June never worked, stay-at-home mom the whole time. What about if June has worked, has paid into the Social Security program, and has earned a benefit on her own? So let's say Ward full retirement age amount $1,000, June full retirement age amount $800. They're both at full retirement age of 67. They head to Social Security together. Ward gets his $1,000, June gets her 800. Social Security is about to say goodbye and good luck, and June goes, hey, can't fool me. Where's my $500 spousal benefit? At that point, the good folks at Social Security point out to June, as a spouse, under the rules, you're required to take your own retirement benefit first. Social Security will then compare your own full retirement age amount to 50% of your spouse's. And if your own full retirement age amount exceeds 50% of your spouse's, then that's all you collect. You collect on one account or the other, whichever one is higher, but you don't get both at once. Because in our example, June's $800 full retirement age amount exceeds 50% of Ward's. Well, that's what she collects. But say she had only earned a benefit on her own of $250. She gets her own $250 first. And then because her own is less than 50% of his, she's given some additional money on top of that. So spousal benefits, 50% of the primary worker's full retirement age amount or the individual's own, but it's always one or the other, not both full benefits at once. By the way, the program is completely gender neutral, meaning if Ward had been a stay-at-home dad and June was the primary breadwinner, then he'd get 50% of hers or his own, whichever one is higher, but not both at once. Next slide, please. So what happens if Ward and June get divorced? Well, for June to collect as a divorced spouse, a few conditions have to be met. First and foremost, marriage needs to have lasted at least 10 years prior to the divorce. And second, for June to collect based on Ward's work record, she cannot be married. Excuse me, Ward can have remarried without impacting June's ability to collect on him. Thirdly, June has to be at least age 62. But here's one thing that does play. I mentioned if the marriage were intact, June couldn't collect as a spouse unless and until Ward was actually collecting. But in cases of divorce, the law says as long as they're both over the age of 62 and the divorce was finalized at least 2 years ago, she can collect based on his work record, even if he has not yet started to collect. So those conditions being met, what's she entitled to receive? Simple, as if the marriage were still intact. She'd get 50% of his full retirement age amount at her full retirement age, or her own. It's always one or the other, whichever one is higher, but never both at once. By the way, divorced spouses are treated absolutely, totally independently of anyone else in the record, and June becoming eligible for a divorce spousal payment doesn't impact anyone else who might be collecting. Spousal benefits, divorce spousal benefits. Next slide, please. Let's talk quickly about survivor benefits, widows and widowers. And here, basically for June, the news is better. Because if Ward passes away as his widow, she's eligible to receive not 50% of his full retirement age amount. No, 100% of what he was collecting at the time he passed away. Oh yeah, still, or her own, one amount or the other, whichever one is higher, not both at once. June, as a widow, could collect as early as age 60, a little bit sooner than on retirement or spousal benefits, but same concept holds. Start to collect earlier, you get a reduced amount because in theory, you're collecting for a longer period of time. And the last point is with survivor benefits, though, while you still only collect on one account or the other at a time, not both at once, it is possible to sequence the collection. So June, for example, widow at age 60 could collect a reduced survivor benefit, and then at her full retirement age, file for and receive a full unreduced retirement benefit at that point. Again, you're collecting one or the other at a time, not both at once, but it is possible to sequence the collection, and the folks at Social Security can help you work out those numbers. Next slide, please. Just a quick reminder about taxation of benefits. Prior to 1983, Social Security benefits completely federal tax-free. That year, Congress changed the IRS code, though, and said if you're a higher income beneficiary, you'd be required to pay federal income tax on a portion of your benefits. Well, that remains true today. The thresholds are for a single tax filer, if you have income from all sources, earned and unearned, in excess of $25,000, or a couple filing jointly, income from all sources in excess of $32,000, you'll now find yourself in a position having to pay federal income tax on up to 85% of the payments that you had received in the prior year. 15% always tax-free, but up to 85% treated as ordinary income, taxed at whatever marginal tax rate you happen to fall under. These days, about half of all people collecting Social Security do pay federal income tax on a portion of the payments that they had received. At the end of the year, Social Security sends you a 1099 form, and you use that in filing your tax return. Question often comes up, does Social Security automatically withhold a portion of my payments every month? Send it to the IRS in advance like they do for my salary? The answer is no. But if you would like to have a portion withheld in advance, you can request that it be done. You fill out a form W4V as in Victor, and you can ask to have a specific percentage of your payments withheld at 7, 10, 12, or 22%. By doing that, you may avoid the need for filing quarterly estimates, but it's not done automatically. Just a quick reminder, this is federal tax rules that apply no matter where you live. In terms of state taxation of benefits, really varies from state to state, but the vast majority of states, 38 out of the 50, do not tax Social Security benefits in any way, shape, or fashion, including here in the Commonwealth of Massachusetts. That leaves 12 states that do, and here in New England, Rhode Island, Connecticut, and Vermont do tax Social Security benefits at the state level in some form or fashion. So just something to be aware of. If you move out of the Commonwealth in retirement, depending upon where you end up, you need to double check with the state taxing authorities to see whether you have any state tax liability on your benefits. Next slide, please. We're coming to the end. Big finish, and almost the big finish. We'll do a poll in a second. Just a quick reminder, you or someone you know has reached the end of his or her rope. You've decided, yeah, I give up. I'm going to retire at the end of June. I've had enough. I want to start collecting Social Security benefits effective with the month of July of this year. What do? Well, just a reminder, Social Security can accept an application for benefits a maximum of 3 months in advance of the month you want to start to collect. So you want to start to collect effective with July. That means any point after April 1st, you can apply for benefits. How do you do that? Well, my advice, use Social Security's online retirement application. To me, it's the simplest, easiest, most convenient way to apply from the comfort of your own home, day or night, wearing your pink footy pajamas for all anybody knows. But just a caution, in order to use the online retirement application, you do need to have established a My Social Security account for yourself. So if you haven't done it yet, I encourage you to do so in advance. You don't want to deal online? Well, you can call Social Security, make an appointment. Now, offices continue to be closed to the public for face-to-face traffic, although they're opening gradually at the end of the month. But right now, you want to make an appointment. It'll still be for a telephone interview, but at some point, you will be able to visit a local office and have them complete the application with you over the phone. One last reminder, Social Security benefits go out 1 month in arrears. So you're retiring June 30th. You want to start collecting effective with the month of July. You'll see that first payment in the month of August, right? And benefits do go out 1 month in arrears. In addition, benefit payments are staggered through the course of the month based on somebody's date of birth. So if your date of birth is between the 1st and the 10th, you'll always find your payment direct deposited on the 2nd Wednesday of the month. Date of birth between the 11th and the 20th, the 3rd Wednesday of the month. And date of birth between the 21st and the end of the month in which you're born, payment will always be direct deposited on the 4th Wednesday of the month. So you're retiring June 30th, your birthday is the 28th of the month. Just recognize you're not going to see your first Social Security payment until the 4th Wednesday of August. So it's something you need to plan for. All right, before we go to the big finish, let's go to the last polling question, which has to do with the future of the Social Security program, another topic that's on everybody's mind.
So Kurt, it looks like people are split, but think that 2034 is when Social Security will run out as per the question. So what's your take on that?
So, and this is a great question, comes up all the time. I always like to answer it by referring to Mark Twain, who once said, reports of my demise are greatly exaggerated. It's important to understand Social Security's primary source of income is payroll tax dollars collected from employers, employees, and people who are self-employed. And each year, the Social Security Board of Trustees issues a report attempting to project the financial health of the system into the future. So many folks I've talked to, particularly young folks, say, well, at some point, there's not going to be anything there for me whatsoever. Well, again, with payroll tax revenue being a regular source of income, you're never going to get to the point where there's no money there whatsoever, absent a complete and total collapse of the United States economy. But what the latest trustees report says is, as currently constituted, assuming no changes to the program whatsoever, no increase in taxes, no cuts in benefits, maintenance of status quo, they do project that beginning through the year 2034, Social Security will have enough money to cover 100% of promised benefits. But at that point going forward, that payroll tax dollars is projected to be only enough to cover about 78% of the benefits that have been promised. So the issue confronting Congress and the American public going forward is how, between now and 2034, Congress comes up with some changes to the program to close not a 100% funding gap, but that 22% funding gap. Social Security will be able to continue to pay 100% of the benefits that have been promised. But don't fall into the trap of thinking there'll never be no money there whatsoever. With that payroll tax revenue stream, there's always going to be money coming in. The issue is looking down the road. Is it projected to be enough to cover 100% of the benefits? And the latest report says, absent some tweaks to the program, some changes to the program, it's not going to be, but it is expected to be around 78% of the necessary funds. All right, last slide, please. So like Lady Godiva, I must come to my close. And I always like to end where I started, just to reemphasize, as you're making this plan for retirement, understand Social Security is a hugely important program designed, though, provide you a base or a foundation of income. And the sooner you recognize that, work with Eric to find ways that you can supplement your Social Security payment, the more likely you are to have that comfortable retirement that all of us hope to enjoy. So I hope the information's been helpful. We'll take some questions now, but I'll repeat the offer made before. If in the course of the next couple of days or so, you come up with questions that didn't occur to you tonight, get them into Eric or someone else. He'll forward them to me. I'll be happy to answer those for you.
Fantastic. So Kurt, we have one question. It's pretty specific, but I think you can probably make it more general. So when someone has both individual and survivor's benefit, if you file for your individual benefit prior to FRA, then switch to your survivor benefit at FRA, do you get the FRA survivor's benefit, or is the benefit reduced because you took your individual benefit early?
Great question. And just to reemphasize, with survivor benefits, you do have the option of taking a reduced amount on one account and switching to the other account at a later date. And the fact you may have opted for reduced benefits on one account does not preclude you from getting a full unreduced benefit on the other account. Now, again, you never collect both full payments at once, but it is possible, as I said, for example, as a widow, to begin to collect as early as age 60 a reduced amount, And then at your full retirement age, file for your own retirement benefit, and you'll get a full unreduced retirement benefit. The fact you may have been collecting reduced survivor benefits has no impact at all on the amount you get based on your own work record. But keep this in mind. Whether you're talking about retirement benefits, survivor benefits, spousal or divorced spousal benefits, while you're under your full retirement age and working, you are going to be subject to that earnings limitation we had talked about. So June Cleaver, widow at age 60, working, making $1 million a year. Well, unfortunately, she's not going to be able to receive a widow's payment at that point, not because she's not old enough, not because she's not a widow, but she is going to be subject to that earnings limitation. But at someone's full retirement age, as we mentioned, that earnings limitation goes away, and she could begin to collect a full survivor benefit, for example, at that point, defer collecting her own right up until age 70, accrue delayed retirement credits for that period of time, and at age 70, switch over to her own benefit, which will be higher because she won't have collected it beginning at full retirement age. Just an important reminder, though, with your own retirement benefit, you opt to defer past full retirement age. Your payment does accrue those delayed retirement credits and increases 0.2% per month going forward. There is no equivalent delayed retirement credit increase in the survivor payment. So it tops out at full retirement age. You'll get the highest, absent COLAs, of course, get the highest possible benefit. But with your own retirement benefit, deferring, you do accrue delayed retirement credits. So many times in figuring out the sequence, taking the survivor benefit first, waiting until age 70 to collect your own may be the way to go. But again, the folks at Social Security can help you understand those options and choices.
To conclude the remarks for now, you will be receiving a short survey. We sure would appreciate any feedback you have. Additionally, if your question isn't answered right now, we will get back to you because we have your information and we can reply to you on that. And if anyone else has questions that they haven't asked, they come up tomorrow or the next day, please send them to me. You can either reach me directly through ebros@infinexgroup.com. I think you also have my phone number on the confirmation. And otherwise, your branch partners or my branch partners, I have my contact information. They'd be happy to meet up with you. We'll probably just take about another 5 minutes because everyone else will also leave. But this was an interesting question, Kurt. On the earned income of the $19,560, can you contribute to a 401k and net W-2 be used so not taxed on Social Security income?
Great question, comes up all the time. And in terms of figuring out whether or not earnings exceed the 19,560 threshold, it is the gross amount of the earnings prior to any deductions for contributions to 401k, prior to any contributions towards health insurance, prior to any contributions towards taxes or anything like that. So contributing to some type of 401k, 403b, 457, while it does reduce your income tax liability for a particular year, it is the gross amount of earnings prior to those contributions that count towards that this year 19,560 threshold.
And then if you could you just comment briefly on the pension offset provision for teachers and how that impacts?
Well, I'm not sure there's a brief answer, but I'll give it my best shot. So there's two provisions of the Social Security program that impact folks who receive a public pension based on work not covered under Social Security. One is called the Windfall Elimination Provision, or the WEP. The other is Government Pension Offset. Both only apply if someone's public pension is based on work where they were not paying into the Social Security program. So Massachusetts school teachers, for example. But New York school teachers do pay into Social Security, so they're not impacted by either one. The windfall provision, that affects you if you get that public pension, but in addition to your public service, have also worked and paid into the Social Security program for at least 10 years. The good news is, if you've got 10 years of time under Social Security, you will always get something every month from Social Security, even with that public pension. The bad news is, in all likelihood, with fewer than 30 years where you've worked and paid into the Social Security program, you'll get less each month from Social Security than you would if you didn't have that public pension, because the windfall provision basically requires Social Security to use a different, as I always say, admittedly, less generous formula to calculate somebody's benefit, but you're never reduced to zero. You always get something. Government pension offset is the other provision. That's how that public pension impacts someone's ability to collect, not based on their own work record, but to collect as a spouse, divorced spouse, or perhaps widow or widower. And here the news is not as good, because under the government pension offset rules, before Social Security can pay someone that divorce, spousal, or survivor benefit, they're required to look at the person's public pension, figure out what 2/3 of the amount is, and offset or reduce any spousal, divorce, spousal, or survivor benefit by that 2/3 of the person's pension. So if 2/3 of somebody's pension is more than what they could collect based on their spouse, ex-spouse, or deceased spouse's work record, well, they don't get anything more. They always collect based on their own work record. They always get their public pension. But depending on the amount of that public pension, they may not be able to get anything more. And why does government pension offset exist? Well, as I talked about with spousal or survivor benefits, you always collect on one account or the other, whichever one is higher. If your own benefit exceeds what you could get in Social Security benefits based on your spouse's work record, you just collect based on your own. And the government pension offset rules changed back in 1977, designed to bring public pensions under that same concept. If you've earned a benefit based on your own work activity, which exceeds what you could collect based on your spouse's work activity, well, that's what you collect. You don't get both at once. So with the windfall, again, you'll always get something, but with government pension offset, depending on the amount of the pension, you may not be able to get anything more based on your spouse's, ex-spouse's, or deceased spouse's work record.
With that, I think we should call it a night. I know Kurt could probably talk for another 8 hours as we contracted him for. But we will make, if it's okay with you, Kurt, the presentation available. We will do that. Please just contact us. We won't just send it out, but if you'd like it, please email us back and we'll send it to you. And with that,
I want to remind them we're going to be doing this again in September.
Oh, thank you very much. We will be, so if you found some things that are interesting and you want to hear it again, come back in September. I don't have the date on me,
It's
Sheila.
the 25th.
Maybe 25th. Thank you very much.
Yep.
And please tell other people who may be interested and or in need of this kind of information. And with that, thank you so much, Kurt.
My
And
pleasure.
thank
Thanks,
you.
everybody. Good luck. Don't forget, if you have other questions, get them into Eric. He'll get them to me. Happy to respond.
Thank you, everyone. Have a great evening.
Take care. Thanks, Brad.